Hi, everybody. Enjoying the conference? Oh, come on. All right, so we're going to be talking about raising in a bear market. You know, even though the prices look like they might be on the rebound, it's not over yet, so don't get your hopes up. But I have four of the brightest minds in the market who are going to talk to us a little bit about how they do it, what are the hurdles, and maybe we can all find some comfort in their knowledge. So, so we're going to start. Soona, why don't you start with you? Give us a little bit about yourself and your background in the company you're with.
Sure. Hey, I'm Soona from Volt Capital. We are a crypto-focused venture firm. We invest in DeFi, NFTs, DAOs, and the infrastructure that power them all. We were some of the earliest investors in Nansen, companies like Magic Eden, Sound, and others. And you know, we're so excited to be deploying right now in a bear market. We think some of the best founders are going to be creating companies over these next few years, and it really separates the wheat from the chaff. So I think we're in an excellent position to really prep us up for a builder spring.
Hey everyone, my name is Sarah. I was for a long time a partner at a large generalist Silicon Valley firm called Greylock, and there I was part of co-leading our crypto investing efforts. I'm lucky to be on the board at 0x. Thanks, Will and Amir, for having me. And most recently, I started a new early stage focused firm called Conviction. Some of the more recent, more recent crypto investments besides 0x I'm in include Farcaster, FTX, Magic Eden, TipLink, Harpy, et cetera. So broadly up and down applications and infrastructure in crypto.
Hey folks, I'm Clay Robbins from Slow Ventures. Slow is a generalist seed fund. I spend all of my time focused on early stage crypto. And even though we're a generalist fund, we have a long history investing in and around the crypto ecosystem, dating back to 2015, 2016, the emergence of Ethereum and alternative layer ones, all the way through to DeFi and the middleware and infrastructure, and now as we start to see that infrastructure mature, the application layer. And so excited for the conversation.
What's up, guys? My name is Alex. If you want to know how to pronounce my last name, you can hit me up after this. So I'm an angel investor. When I angel invest, I predominantly focus on DeFi and crypto. I'm also a VC in a couple of funds that do real estate and biotech, but a bit of crypto as well. And I'm the founder of AngelBlock. And AngelBlock is a non-custodial, protocol-based way of doing fundraising in crypto. So we're trying to add more decentralization and transparency into the token, especially the token raises. So I think my perspective is a bit different since I'm based in the EU. And we're going to have a lot of the American VC talk here, and hopefully we can get a nice balanced discussion.
All right. Well, I think the elephant in the room is the bear market itself. So it's easy to raise money when prices are going through the roof and people are trying to jump into crypto because they don't want to miss the boat. But in times like this, when the boat kind of sank, how do you then turn and raise capital? What are the key challenges that you face today? Soona?
Yeah, so a few things. So one is you have to raise on, it depends on what stage you're at, but largely you need to prove traction in some way or demand. You can't raise as easily on a good story. And so especially if you're going in for second or third rounds of funding, your investors are going to want to see healthy numbers. And then secondly, is the types of products that get funded. So for the most part, retail has largely evaporated, and we've seen anywhere between 40-60% drawdowns just in, for instance, NFT volumes. And so what that means is that typically founders are now building where there's demand or at least feedback loops for how they're doing, and that typically is infrastructure projects. And so those are the kinds of products that if they're right out the gate or getting a first round of funding are more likely to get funded in a bear market. But on a positive note is the types of investors that are still investing in the bear market are largely folks that have a long-term conviction in crypto. They'll be with you through bear and bull. They aren't out chasing whatever the new hot topic is in tech. And so there are trade-offs, but that's what you have to consider when you're going out to raise right now.
I think it's a good fundamental reminder for investors and builders that crypto company building is company building, right? Like, I think there are definitely really interesting economic models where you can innovate, but I think I think there's plenty of interest. I mean, if you look at the people in this room and people investing in crypto, in continuing to fund innovation that has a real business model behind it and has user value. What's gone away, which is actually quite healthy, is like the interest in funding what really looked to me like greater fool's theories of companies, right? If all you're doing is making money off the next idiot in retail by shilling some token that has no fundamental value or sort of long-term theory, like that will not work anymore because those retail investors are not coming. So I think the only thing I'd add to what was just said by my friend here is I do think that there are interesting consumer-facing crypto plays as well. Like, this doesn't work unless the ecosystem gets better, but it can't just be speculation.
Yeah, I think that the three things that I would note are, one, between last year, the last 8 to 12 months, and now fundraising is taking a lot longer to get done, and so that's a function of a lot of the leverage moving over to the investor side, and surprise, surprise, it's good to get to know folks before you invest in them, as opposed to waiting 48 to 72 hours to make a decision, which we saw a lot last year. I think the second piece is that, especially at the seed where we primarily focus. The ability to underwrite or willingness to underwrite multi-variable bets as opposed to single variable bets has largely gone away. Where historically, you could come in and say, hey, I'm raising a seed round, and we think we're going to do 1, 2, or 3 things, and that's going to prove or disprove whether this company is going to work. Now, I think most investors are looking for that one thing where, with 18 to 24 months of capital, you can prove or disprove that hypothesis before unlocking future rounds of capital. And I think the third thing, and particularly in the investor set, that's healthy as a part of this market change, is the exit of a lot of folks that were saying, positioning themselves as crypto VCs or venture capitalists, but in fact were traders. And so that disappearance of traders versus investors is actually a healthy development. And so I especially at the seed, I think it's never been a better time to raise. I think it's a bit tougher at the follow-on rounds, as Sarah alluded to and Soona alluded to. You need to see the traction and the numbers, and that bar to clear to unlock future rounds of capital is quite important. And I think, too, the folks that are principled about when they are setting their valuations at the seed, it really sets you up for success over the long run. That's not just talking as a filthy venture capitalist. It's actually a good way to build value incrementally through company creation. And so, those are the few things that we're seeing at the moment. But it's definitely not all doom and gloom out there.
I'm going to leverage the geo play right now, which I mentioned in the beginning. So, obviously, looking back now, it's pretty safe to say that we've been in a bear market since January of this year, more or less. So if we're looking at VC funding for Q1 and Q2, obviously the US and Asia, that went down. But the number of deals made in crypto, in blockchain-based companies, in Q2 was actually on par in the US and in the EU. So the EU was actually on the rise there. So US falling, EU rising, which is something really interesting because when we talk about Web3, a lot of times we're trying to leverage this, geo-agnostic kind of way of doing things, but cycles affect different parts of the globe differently, and it can just range that maybe all of this downturn is kind of happening a bit later in the EU or not, or maybe we're just focusing on different rounds. So another really interesting thing that happened was actually Africa funding for VCs, for crypto-based VCs, it skyrocketed like 189% from Q1 to Q2. So there's still interest, there's still a lot of appetite in this market. It just depends where you're looking, right? So obviously the US is one thing that, you can't really argue. The appetite for Series B, C, D is way higher in the US than anywhere else in the world. Like, that's where the real money is. When it comes to those kinds of rounds and those kinds of valuations, the EU is not really seeing that right now. But the worst part about this bear market is when you have traction, when you're showing growth, it's way easier to get funding. Like that, it's that easy because the riskiest aspect is the pre-seed, it's the seed, right? So if you have that traction, you're still gonna probably get funded if your idea is good and if your business model is actually viable, which in crypto isn't always the case. But the way that the EU is setting a lot of things up right now with MiCA, especially that's markets and crypto assets, that regulation that was passed in October of this year, and it's probably going to take like 2 years to implement. We have a lot more regulatory clarity in Europe, which is really cool because that's probably, despite the fact that so many deals are being made in the US, the lack of regulatory clarity is probably one of the biggest hindrances in this space right now.
So I want to go back to something that Sarah mentioned earlier about fundamentals and projects. Are there any misconceptions that a project that you've seen when they approach you for potential funding, that they just have no idea what they're doing and how to actually approach you? They have none of the fundamentals set up already. Have you experienced that? Have any of you experienced that? And what do you normally say to them? Do you like try to ease them back and to start over, or what do you do?
I don't know if this is a misconception, but I think one of the things that I'm consistently surprised by, and this isn't a judgment on like entrepreneurs broadly, like but I am consistently surprised that people are not doing competitive research when they start companies, right? And I think all of us as investors, we get to see so many companies that my data should be much better than the average crypto entrepreneurs. Yet, if you're focused on one problem, it is your job to go figure out who else is trying what you're trying. Why has it worked or not worked? And to understand the alternatives that your customers face. And so, I see really interesting innovations that I'm excited about every day, or people who have a deep insight into like why a product experience can be better in some unique way, and I'm excited to back those companies. But if you're and I'm not saying this is a bad category, it's actually like a fundamentally interesting idea, but if you are building like NFT minting for creators number 47, you really better understand why it's better than the other 46 plays.
Soona?
Oh yeah, exactly what Sarah said. There is no faster way to lose your investor when they ask you what the competitors are, and you just say there are none. That's probably the worst answer that we've seen. Right, exactly, because we've met them. I'd additionally say, because crypto has many options with regard to the tech stack that you can build, is choosing where you're going to start and having a fleshed out thesis as to why. You don't necessarily have to agree and be in consensus with the investor, but if you're going to start in a certain ecosystem, whether it be Ethereum, Solana, whatever, or want to eventually expand to multi-chain support, have a strong thesis and understanding of the ecosystem that you're building in.
Clay?
Yeah, I think the only thing that I would add is one of the most common issues or misconceptions I see is the conflation of traction in the context of token issuance. In that there are a number of different ways where tokens can be quite powerful in creating user lock-in, but there are a ton of different ways where it can give the illusion of traction and the things like product market fit, but when in fact it's actually screwing up your sense of what's actually working. And as things like the supply schedule titrate down, what's left is you've used the single bullet to subsidize acquiring users, but in fact you actually don't have a product that's working and don't have the ability to reload, because people often get wrong that issuing a token is kind of a one-way door, and once you do that, it's really hard to refactor that. And so in terms of projects that I talk to, the most common issue that I see, even at the seed stage, is, hey, we're going to have this specific mechanic to acquire users through token-based incentives, but they don't actually have a good way of defining who their users are. And so the thing that I always counsel folks is, get the product out there, drive distribution, figure out who the users are and what incentives you actually want to accelerate with token issuance, and then backfill it from there. Because the beauty of where we are in the market today as the structures for raising capital and issuing tokens has matured is that things like a token warrant actually provide you, nearly infinite optionality before you actually take that step. And so that's where I spend a lot of my time in sort of guiding folks away from that as the thing that creates the moat and creates product market fit, and actually go with a structure that builds the product first and then worries about that later.
Could I touch upon what Clay said? Because that's actually a really interesting point, is the entire aspect of token issuance, right? And a lot of times when we talk about fundraising, it's like talking about crypto. Like crypto means so many things, and so does fundraising, right? Especially just looking at the way that so many projects raised funds back in 2017, 2018, which was ICO, which was just totally unregulated, and the majority of those companies died, or there's still no product after raising $100 million. But with fundraising, it's really interesting because on the equity side of fundraising, you invest and you're hoping for a liquidity event in terms of like an IPO, 10 years down the road. And the thing about token issuance, and what Clay said that's really interesting, is with token issuance and raising via token, you are speeding up that process, and the liquidity event occurs right at the birth, right? Like that's the first thing that happens, is the liquidity event. One interesting thing about tokens and raising in tokens, and whether you should even have a token or not, like I'm definitely seeing, and this is something that definitely turns me off, is you have a lot of companies that don't really need tokens in general. Like a lot of time they think the business model is the token, which is kind of weird, and then the token doesn't even have any utility value, which is really, really strange. But back in I don't know if you guys remember, like in 2017, when a company didn't really have an idea for what a token should do, it was always like, oh, it's payments, and negative 10% on whatever product or service that we have, if you pay in our token, it's just going to be cheaper, right? So right now, it's kind of similar, where a lot of these companies simply don't need to have a token, but they're still trying to push you a token, which is super problematic. But a lot of times when it comes to, I think governance is kind of one of those aspects right now, like that people don't really want to take part in, but if you don't really have an avenue for what the token should do, you just add governance to it. And it's like, oh, it's governance now.
Can I add to this? So just like fast forwarding and making a comparison to something that is relevant from Web 2 land, I have a lot of friends who do not enjoy running public companies, right? And so this is actually quite similar in some way. Don't get me wrong, like there is a lot of value to incentives and ownership and participation from a community. That can be really powerful if it makes sense in your business model. But if you think about really early companies, a lot of us are doing seed and Series A stage companies. You are making often quite permanent decisions about who you want in your community, how they participate, what the supply of your token is, how governance works, and you cannot undo it. And it becomes very hard to change that structure. And so if you think about how hard it is in general to build a business when you don't have all the answers because you're a seed stage company, like doing that with an entire community breathing down your neck saying, like some segment of your users is going to be like up only, like you cannot guarantee them that, right? And so I would just say, I think if you compare to the lived experiences of many companies, the attraction is like free capital, right? And people who want to participate in your success, and sometimes like real ecosystems, but I'd say like it's a far more complex bargain to enter into that I think a lot of early stage companies are not working through.
Yeah, and just one last thing to add on that. Not only community, but employees too. Liquidity on non-cash comp is actually a double-edged sword in that it's all great. It affords your employees optionality, but it also gives them the ability to, basically remove their entire economic upside incentives by selling on the open market, which is not necessarily a good thing when it comes to retention in a lot of ways. And we've seen that play out many times over with different companies that had that as a component of their non-cash comp. And it's great that employees are able to get that financial windfall, but then it really lowers the incentive to stay, in a space where there's already plenty of economic opportunity costs to staying at a company as opposed to building your own thing. And so, that piece of it, not only with community, but with your employee base too, is worth considering.
So, because we're talking about building in the bear market, or raising in the bear market, I should say, what kind of projects do you see now that have the most potential to succeed? Because it's easy, like what Alex was saying about companies that would just say, we have a token so what, right? But is there any kind of project that's come across your desk that you say, okay, we could do something with this. This is not, you don't have to name any names, of course, but like, is there any particular kind of project that you see as doing really well right now?
We're seeing, from a thematic perspective, we're seeing a resurgence in interest in DeFi projects, reimagined on different chains, with reimagining order books and just different parameters that have been established. From this DeFi wave, we're also seeing app chains as a thesis being experimented on. We're seeing ZK X, like ZK whatever, so ZK EVM, ZK bridges, ZK. And then we are also seeing on the consumer side a lot of gaming plays, and that's both titles, which are the actual games themselves, but then also the infrastructure that powers them.
Sarah?
I'm trying to think about what to add here. I'd say broadly, like I think people now, not everyone, but many people have accepted that we're going to live in a multi-chain world, right? I think allowing the fiat and crypto ecosystems to be more liquid to each other and providing better infrastructure remains an ongoing interest. And then I'd say, I think usability of crypto and sort of better consumer experiences, entry points continue to be important.
Yeah, I mean, internally we talk about crypto in 3 eras. The first era being the immaculate conception of Bitcoin and everything that came with that. The second being the implementation of generalized smart contract infrastructure that made the advent of Bitcoin useful in terms of a general purpose compute platform. And now we kind of think that we're in era 2.5, in not the Web 2.5 marketing term, but just 2.5 generally, in terms of there's a little bit of work being done to make the infrastructure work. So rounding out things like privacy that need to exist today in earnest for attestation, but also obfuscation to exist. And then the other part being extending that infrastructure to make it both usable from a developer perspective, so actually opening the aperture to folks that don't necessarily want to get up the curve on Solidity and have a more friendly interface for developers to interact with, so tools there, but then also useful for consumers, so at the application layer. And so I think a lot of those buckets were touched on in Sarah and Soona's remarks, but that's generally how we frame it, is that there's a little bit of era 2 occurring, but also we're starting to see the emergence of what we think will be those types of applications that really extend crypto to billions of users as opposed to a couple 100 million as it exists today.
Yeah, just to touch upon, I'm always last, so I just get to touch upon what everyone said. But L1s and L2s
Don't worry, you're going first for the next one.
Perfect. L1s and L2s remain really interesting. As mentioned before, it is a multi-chain world, and I don't think that anyone can really argue with this point. But despite the fact that there are many L1s, apart from ETH being number 1 in terms of market cap, but obviously, if you're, I was judging the pitch contest out here earlier, and if you're trying to build something for the emerging markets, ETH is not the way to go. Either you're going to go right to L2, which kind of increases the complexity, but having a high throughput, low cost L1 is still really enticing, and I still don't think that we've seen something to take that crown just yet. So that's definitely something that's really interesting, and I know there's a few projects in development currently. Some even launched really recently, and we can talk about that later. But definitely DeFi. I definitely have my ear to the ground looking at everything that's going on with DeFi. To this point, if you'd ask me to explain AngelBlock in one word, I would definitely call it a DeFi protocol, but we're never going to be in all of these listings on DeFi Pulse with a high TVL, because TVL, the total value locked, is not the way that we really do business, right? That's not the holy grail that we're going after. And it's easy when you're predominantly doing lending and borrowing, which is, I'll just say some arbitrary number, 90% of DeFi has been lending and borrowing in some way, shape, or form, right? It's really easy to have a high TVL because that's what you're chasing after. So I'm really interested in going after DeFi that's not necessarily the TVL is the end game, and it's not just lending and borrowing. I know there's a few protocols working on under-collateralized lending, which is really, really interesting, and it's something I'm actually investing in one of those protocols right now. I think that's going to be super interesting. So basically, the evolution of DeFi, like we were promised a second DeFi summer. We were promised DeFi 2.0, whatever the hell that means. So I'm trying to see in which ways DeFi is going, and that's something that I'm really keen on learning more about investing.
I just want to react to something Alex and Clay had said. Like, I think, if we're in the era of 2.5, like there are a lot of still quite important unsolved problems, right? And maybe people consider them around the edges. I think depending on where you live geographically, some of these are more important than others. But privacy, bridge security, general consumer wallet security, like these are pretty fundamental problems I think we're going to see solutions to eventually, and we're on the lookout for.
So, Alex. All right, so one thing that we have to deal with in this space are skeptics, naysayers. It's a scam, it's a Ponzi. We've all heard that over the years. So as people whose job is finding the right projects to fund and things like that, what do you say to the skeptics that come to you and say, why are you putting your money into this?
Well, we did something, and I mean the royal we, as the crypto community, we did something super genius, and it seemed to happen overnight, which is we stopped saying crypto and we started saying Web3, right? And we rebranded essentially. That's what we did. So that's one thing is like, okay, I'm not going to invest in crypto because first of all, crypto, like currency that's backed by cryptography, that's what crypto means. But crypto sounds so sketch in a way. Like if you're talking to a normie, it does sound really sketch. And who wouldn't want to invest in Web3? Like Web3, that's one more than Web2. That means it's better. It's obvious. So I think it's just a natural maturing of the market, and where it's hard to notice it until you actually take a step back and you remember like how unruly MetaMask was back in 2017, the amount of problems that we had with it. If you remember the conversations you had with your mom back in 2015 when you went full-time into crypto and she said, are you a drug dealer now, right? So it's, unless we take that step back, it's hard to notice how far we've come, essentially. But I think that we're on our way. So I don't have those conversations anymore. Maybe it's just the people that I spend the majority of my time with, but we're heading the right way. But I feel that, yeah, at the end of the day, I just don't talk to any people that will call crypto a scam. Like everyone's been onboarded. They've been red pilled or blue pilled or whatever pilled.
Nice. Soona, what do you think?
So I think a few things. One, it's true that there seems to be less skepticism, and that's largely a consequence of more institutional adoption for people that want proxies or signals that they can point to, and where we are in the adoption cycle. That said, there is still some skepticism, and a good way to answer that is to really anchor people in the future and wake them up to things and trends that are going on now. The fact that the dollar is worth 70% of what it was in the 1970s, is that a trend that can continue? Is a third of New York being underbanked, with the center of gravity being the Bronx? So you don't even have to look outside of the US. Is that also tenable? Like there's these trends that you can look to and point to and think like in 50 years and 100 years, like do you think this is going to be the same? The separation of, the disintermediation of just these central parties that are obfuscating money, that are manipulating and destroying our money, it's very convincing and easy to make the argument that things are probably going to change. And when you look at who's doing the building, and you think about which side of the bet you're taking on this tech, I mean, history shows us that it's usually the tech entrepreneurs that come out winning. We see Amazon.bomb. I mean, just how cringy and how stupid did those journalists look in the late 90s? And I oftentimes think about that and think about how I don't ever want to end up looking back and being on that side of the bet. And so usually you don't want to take the side, you don't want to bet against the builders, especially when time is on their side. I really think it all comes back down to that.
Sure.
I still talk to a lot of people that are skeptics, and I think that they've found renewed confidence with the bear market, right? Like, you idiots and scammers. So I think they definitely exist. My circle might be a little bit broader than Alex's. I tend to react in two ways. One is, like, they are correct that there are influences that are less healthy in the crypto ecosystem, right? There was an enormous amount of get-rich-quick speculation, and that continues to exist. And a lot of people lost their shirts and will continue to do so, and there are bad faith actors, right? So one piece is just, personally, I don't take responsibility for the ecosystem, but I say, like, I am trying to do business with people who are trying to put a fundamentally useful innovation in the world. I believe that crypto is one of those, and the teams I work with, like, if you've met Will and Amir and the team at 0x, I'm biased here, but I think they're missionaries, right? They're trying to produce something that is useful to the ecosystem. I think the second piece is not to, I agree that, like, sort of right side of history, as Soona said, but telling people that they're dinosaurs generally doesn't, like, progress their point of view. And so I tend to go back to, like, being very heartened by, even the small or classic use cases that people can understand, right? So I grew up with a friend who's Venezuelan. If you know anybody if you come from a government that is, like, less functional, or if you experienced hyperinflation, your openness to something like crypto is much higher, right? If you think about yesterday, I was just in Portugal for a general tech conference, and I met somebody there who was working on what is a sort of a classical secondary markets application of crypto, but he's a 5th generation winemaker, and he's like, I'm not making any money from, like, all of the work we've put into producing this wine because the secondary markets take it all, right? There's no visibility and provenance in this, and so I think, like, trying to pull people back to some of the most obvious but still not widespread use cases of crypto, I hope will open people's minds to the area more.
Well said, across the board. I don't have a lot else to add other than I think, a lot of the skeptics that I talk to are always asking the question of, well, what's the one thing? What's the one thing that, is going to move the ecosystem forward? And they look for a particular use case. And I kind of default to something that I learned very early on in the ecosystem, which is, one of the foundational elements of crypto and applications that are built on top of it is open source. And it's really difficult to bet against, anyone, any developer anywhere in the world with an internet connection having the capacity to just experiment. And that experimentation builds on itself. We've seen it, in more incremental senses in terms of things like DeFi forks, but it allows for discovery and entry points to exist across the world, which I don't know of a tech trend where you've seen that unless it was things like knowledge sharing on the internet in the early days. And so where I default to is it's very, very difficult to bet against open source, and that's something that I'll continue to underwrite until the cows come home.
Yeah, Alex was talking about rebranding from crypto to Web3. Sometimes I talk about, like, and crypto certainly has important real use cases beyond money, like identity and credentials and all these things that we talk about. But, like, a pretty important use case is money. And I think if you ask people, do you believe that money should be more programmable? And, like, do you need to understand that balances do not change in some way we can trust for that to happen? I think people are more open to that.
I just meant, just for clarity, that Web3 has a better ring to it than crypto to someone that, never has touched a thing. Like if I tell my grandma Web3 versus crypto, like, it's pretty obvious.
I'm, like, progressing the brand.
Yeah, no, you're fine.
We don't want to be known as criminals and scammers anymore.
Exactly.
Right. Well, thank you, everyone, for joining us. We're going to open up for a few questions. If anybody has anything they'd like to ask, feel free. We have about 10 minutes until anyone?
I have a question. I'm supposed to hand the mic out. Y'all are talking about the token as part of this equation. What about when the token does offer a path to liquidity for investors and therefore can force higher valuations, or the Sybil attack potential increasing user counts? How do you take that into account when you're analyzing a deal versus the companies that aren't doing those things, using their token for that type of work?
Yeah, it's a good question. I think that if the token has a functionality that, to your point, enables security, enables some core functionality that otherwise the product can't exist. There's a lot of merit to that. But I think the variant that, in particular, I was alluding to in my statements on it is around user acquisition, and that being sort of a shortcut to a more capital efficient way to acquire users, which is essentially give them free money. And that variant of it, I think, has a very short shelf life in the context of creating long-term value. Obviously, there's exceptions to that rule, but when we look at it, we look at, is it going to be a core part of the product, or is it effectively, a lot of these tokens act as more or less just a pass-through to dollars, right? They get the incentives, they earn them, they maybe speculate on the price a bit, and then they sell down to USD. And so for us, the liquidity is great, but we invest in our LPs invest on a multi-decade time horizon across multiple funds, and so and again, this also gets to the taxonomy of investors in crypto venture, where there's folks that call themselves venture, but they're in fact traders, and so the trade is actually quite good in many senses of investing in tokens, but the investment is where you actually have to do critical thinking, which is often difficult to do just as a basic trader.
Yeah, and taking it back to the crypto J-curve model, right, by Strzesniewski, like that's, which was obviously taken from private equity markets, but what's really interesting is I noticed the word that you used is giving free money, because it's a very US compliant, quote unquote, way of giving users a taste of the token is to do an airdrop, right? Because SEC and Gary Gensler, it's a big no-no. So that's not what we see in Europe and in parts of Asia, where raising via token is still not only doable, but it's a pretty feasible model. But when we're looking at the J-curve, right, it's the current utility value versus the discounted expected utility value. So it's very doable to plot it on I'm not sure about multi-decade, but definitely multi-year, just because of the way that this token the token features can be later implemented, and the way that they're currently implemented, and how that's basically going to react to price in a time scale of, I don't know, a few years, right? So that's just one thing that I wanted to add, but definitely agree with what you said.
I think they touched on everything. I think we should ask Brian's got.
Hi. So I want to ask the venture capital, how's your fund performance? Like how many projects you exit in good or bad?
Could you repeat?
Sorry. Yeah, I wonder how's the performance of your VC fund? Like how many projects you exist in good or bad? And what do you see how you're gonna do in the future in the management?
Yeah, so to set context, I believe Lightspeed had run the numbers 6 or 8 months ago, and I think the average crypto fund was at a 7x. So performed remarkably well. Obviously, those numbers look a little bit different in a bear market, but in general, you're still held to the same standards as what a good return looks like in general VC as well, because oftentimes these are increasingly more the same LP pool. LPs and institutions are getting into crypto. So you're looking at anywhere between, we've seen as low as, for good fund returns, like a 3-4x to some funds are performed up to 26x on the venture side.
So maybe I'll just provide some industry context since I just raised a fund. I think one of the things that's been educational, maybe for all of us, is I've been doing venture for 10 years, and it probably took me 5 to realize that even if you're an early stage, long-term oriented investor, you live in a greater macro context, right? We are not working in a vacuum. Anybody who's a trader fundamentally understands this. But LPs would say that a benchmark high quality venture firm, if they're in the wrong part of the cycle, they might return 2x. If they're in the right part of the cycle, they might return 8x. And let's say this is high quality, top 15 percentile, right? And so I think that's overall useful. I just started a venture fund, so I'm sitting at a solid 1x over the last month, but I'll let others comment. Thank you.
Here we go.
Hi guys. So I know you guys talked about like multi-chain future. So I was wondering if you guys had any thoughts on specifically L2s versus kind of the app chain narrative. So like, what do you guys think? Like DYDX started to create its own chain, or do you think general purpose blockchains like Ethereum or the L2s that are sitting on Ethereum are going to win? Or like, what's your just general thoughts on this kind of area?
So it's probably the top percentile of projects that are going to choose to build on app chains, because you do have to understand that there's a huge amount of engineering resources that you have to pour up front in order to build your own chain. And the reason that they're doing it is because they're popular enough and they don't want to get priced out, and they want customizability over consensus and how they design their architecture of their actual chain. What will likely happen is for the vast majority, they can use more generalized solutions because they probably don't run as great a risk of being priced out. They are not in a position to be able to put in the resources to hire the engineering teams or throw in the dollars needed to build their own app chain. And that's not considering the layer 3s, supernets, subnets, or any of those that are also in the works.
We've got one back here.
All the way in the back.
Yeah, my question is, what do you say to the projects that come to you for investment and are just another NFT minting platform or project number 46? Because you don't want to scare them away from the space and you want them to keep building, but maybe that idea specifically is not the one that will get them the funding.
Yeah, I think that this brings up something that I meant to mention earlier, which is around different ways to sort of prove early traction without taking dilutive capital. So one of the things that is a great backstop that crypto has that very few other industries have is a broad set of grant programs that exist around the ecosystem, where you can get a few $100,000s of non-dilutive grant funding if you're building something truly novel in an ecosystem that wants to see that flourish. And so I often point folks to those types of programs if it's too early for them to be a candidate for seed investing, because it allows you free money, to keep using that phrase, to actually go out and prove the hypothesis that you then want to use to go and then raise that seed round that allows you another 18 to 24 months with a little bit of dilution to go and do it. So that's one common reaction that I have in terms of pushing folks to those types of programs.
I know you were just using that as an example of the NFT minting, but I want to run with it real quick. So I actually wrote a thread on this like 2 weeks ago, I want to say, something like that, comparing Magic Eden and OpenSea. So obviously trading, but there's NFT minting as well. And it was basically NFT trading volumes, but in context of which chain the marketplace launched on, right? So if you're looking at, obviously, OpenSea is ETH first, right? Magic Eden has been Solana first, but they've integrated ETH. And even though OpenSea, I think their Solana daily active users is somewhere in between 100 or 200 actives, and the trading volume is something around 12 to 15K per day, which is nothing. But Magic Eden is really cutting into OpenSea's Ethereum users and the Ethereum daily trading volume, right? So that's something that's really interesting. So just running with this NFT minting example, I would say, what's the unique selling point? If you're just going to do it on Solana, or if you're just going to do it on ETH, yeah, there's incumbents that are going to take away 99.9% of your business. But if you're looking at a lot of these newer L1s, like Aptos or Sui or Aleph Zero, there really isn't any first mover advantage just yet, because only 2 out of the 3 I just mentioned have launched, and I think only 1 has smart contracts on mainnet. Actually, I don't think, does Aptos have smart contracts on mainnet yet already? So 1 out of the 3 have smart contracts on mainnet. So you're basically going to be competing with everybody, from day one. Because I know Aleph Zero smart contracts are coming this month, I think. But that's something that I would focus on, is which chain are you using, and is it going to be cross-chain? Is there interoperability and all that good stuff?
All right, we're about time, everyone.
There's time for one quick one.
One more? Really?
Yeah.
Okay. We have time for one more, apparently.
Okay, just because I both use that as the sort of like cliche crypto, I'm new to crypto, here's my startup idea example, and I think you're also a Magic Eden investor? Yeah, okay. This is an amazing company. It's actually, I just want to tell the like one part of the story that is interesting. Just because like it's an obvious idea and there are competitors doesn't mean you're wrong. Right? And so like I would like to recognize that with humility. We're very lucky to be Magic Eden investors, and I'd say like these are founders who thought very deeply about the problem, like took a very aggressive attack with certain tactics that were not obvious to others at the time. They did not start as the only like Solana first NFT platform. They did primary and secondary, and then within secondary, they actually focused not on like the head projects, but on community building in sort of the middle part of the distribution. And they executed like animals, and they're like very ambitious. And so obviously I'm like biased with my love for the team here, but I'd say like, it's not, you know, if I react like that to an entrepreneur, it's not, this isn't gonna work. It's like, hey, it's a bloodbath out there. Like, what is your advantage? And for the Magic Eden team, somebody like Sid had been, this was his like third crypto company where he'd been building for 2 crypto winters already. He'd really thought about what it would take to win. And like, that's very convincing versus like, I just decided like, you know, the world needs another NFT marketplace.
Clay, what were you gonna say? Okay. Okay, so that's our panel. Everyone, thank you for joining us today, and thank you to our guest, and they'll be around, and stick around for our closing.